Hello and welcome to the Exam 1 review. You might wonder why we're doing this on video. It's partly because we need time in class, but it's partly to help you. And let me show you exactly what I mean by that. So here's a random video of mine, has nothing to do with class. So listen to it for a second. That's incredibly slow, incredibly boring, sure to put you to sleep. So what you need to do is, this video, of course, is in YouTube in the address I've given you. So you need to open it up in YouTube, hit the little gear icon, and change that playback speed to something like 1.5. I guarantee you'll still understand everything. You'll get it in much less time, and it's much less painful. Listen to that. Much better. Okay, so there we go. Enough of that. Let's jump right in. So what I'd like to do is go over the key concepts, definitions, and formulas for everything that we've covered so far. And as you know, these handouts are posted for you so you can follow along and mark them up if you like as we go. So we started in the first class learning about bonds. Bonds are fixed income contracts. So if this were a bond issuer here, they'd get a bunch of money in return for contractually promising to make these payments. These are called interest payments for a certain amount of time. And then typically at the end of the contract, the initial amount of money that was borrowed is also paid back. And when we draw up visually a contract like that, we call this a cash flow diagram. Okay, and as we know, bonds are transferable contracts, so the lender has to provide these cash flows to whoever is holding the bond, and it doesn't matter what the bond might be trading for, what price it might be trading at in the marketplace. The issuer of the bond just has to follow the contract no matter what. Okay. Um, so we have looked several times at the Great Recession, and we will continue to throughout the term. So good to know the key points. March of 2009 was about the nadir of the Great Depression, although of course we didn't know it at the time. In 2008, the S&P stock market, the stock market represented by the S&P 500, fell about 40% and then another 20% through the middle of March. And there were all kinds of crazy things being said at that time by very smart people like Paul Krugman, etc. Okay. And we looked at this bond example for HCP without knowing much of anything, but it did kind of give us a framework that's good to think about through the semester, starting with a qualitative analysis and then using some of our accounting knowledge. Particularly, we're going to be drawing all semester on balance sheets, income statements, and cash flow statements. In this case, we looked at the balance sheet, which showed that this particular entity, HCP, had many, many more current assets than current liabilities. That gave us warm, fuzzy feelings because the bond contract we were thinking of buying ended in 6 months. So we didn't care too much about other stuff on the balance sheet in the distant future. And then in this example, the other thing that we checked was a set of cash flow statements for HCP. And we looked at the four most recently reported quarters, and we remembered that, of course, for cash flow statements and income statements, unlike balance sheets, these are flows of cash, so they are additive in time. We saw things like that. And net net, if we considered all the cash flows for the company, this company is generating a lot of cash. So about 2.5 months ago. It was in a very good position to meet the debt contract, and also again during the past year, as of about 2.5 months ago, the company was generating a lot of cash, not burning cash, so prospect look pretty good. Okay. And so we went ahead and bought that bond, and we did pretty well with that. With the key point, very little risk. We're going to keep coming back to risk all semester. Okay, so the key aspects of finance, you need to know what it is, okay, and what it studies, okay, financial instruments and related derivatives. We looked at those in some depth. We identified 3 branches of finance, and we pointed out that businesses in this country to survive must do only 2 things, right? Okay, so make more cash than you spend and follow applicable laws. And of course, we talked about you could choose to do much more than that. And we looked at some current examples about how the Business Roundtable is changing what they feel is important for any business in this country, from just doing these 2 things and maximizing shareholder value to doing these 2 things and maximizing stakeholder value, which is quite a profound change. Okay, all right, on to handout number 2, capital markets and instruments. So we defined capital, so that's our cash raised by entities for big projects, right? Not for day-to-day operations. And source of capital is just anywhere or anyone you can go to get cash for your big projects. And so there are 2 types of capital sources, okay? And we return to these, we will return to these all semester. We've returned to these virtually in every chapter, right? So debt capital is some contractual type of thing where you're taking out a loan or you're issuing a bond, in either case contract specifying the cash flows that you have to issue in the future for getting a bunch of cash now. And equity sources, issuing shares of stock, that's increasing the size of the ownership club of our entity. And also we consider as an entity source retained earnings, which is net income minus dividends. So that's money that the firm has generated from operations and that it has not chosen to give back to its owners as dividends. So those are all our sources of capital. Capitalization is our description of the forms of capital an entity has used, and we looked at 2 ways to think about this. This is the GAAP way, okay, where the things in blue again represent capitalization. Debt liabilities and equity. Debt liabilities are only our interest-bearing liabilities, okay? A bunch of people have been confused by that. Okay, so that does not include things like accounts payable. That's your operating day-to-day liability, okay? And the difference between these 2, which we've come back to several times during the semester, is that we can measure these things based on GAAP accounting, or we can measure them based on market value. And particularly, there's a big difference between equity GAAP and equity market value. Liability is pretty much GAAP. They're very close to market value. The big difference is between equity GAAP and equity market value. And we say in either case, a firm is capitalized by its debt and its equity. And financial markets, we got into any marketplace where firms or individuals go to raise cash on the one hand, and also any marketplace where financial securities can be traded. So what are financial securities? Stocks, bonds, loans, all that stuff. Okay, and then we looked a little bit at typology. Financial markets are broken down into long-term and short-term. Short-term are typically called money markets, and there are whole classes on money markets. We're not going to worry about that. We're much more interested in Intro to Financing long-term markets where companies go to get funds for big long-term projects like launching a new product line, building a new factory, buying another company that they think will help them in the future, that type of thing. And it's also where long-term securities are traded. Okay. So as we say, we're focused on long-term financial markets, and there are two types of those. Primary markets, that's where you go to issue stock or get a loan or issue bonds. And secondary markets are where stocks and bonds are traded among all of us mere mortals, and also the issuing company can get involved by buying back their stock. That would be a secondary market transaction, or buying back their bonds. Okay, and capital markets are a subset of long-term financial markets. Capital markets are restricted to marketable securities. Okay, so we could go to a long-term financial market and get a big loan, and it might say in the loan contract that this contract can't be transferred to anyone. That would not be illegal. We would not be thrown in jail for that. But in a capital market, we would need to have a bond, or we would have a loan that could be bought and sold by others, or stock. And typically this happens on exchanges. We talked about a bunch of exchanges: New York Stock Exchange, NASDAQ. We looked at some bond exchanges, things like that. Okay, so equity capital, you get equity capital by how? Selling shares of stock, right? And we talked about the implications of that. And again, the key point is that shares of stock are not contract. Shareholders are promised nothing except the implicit guarantee that the management of the company will not be fraudulent. And stockholders, in the case of bankruptcy, are usually totally screwed. Why? Because debt capital, debt has these contracts where it says in the contract, if the company runs into trouble, the debt folks get paid with whatever is left of the company first. And if you're in bad enough shape that you go bankrupt, the debt holders don't get paid 100% of what they're owed, and so there's absolutely zero left for the shareholders. Okay. And debt capital is get debt capital by taking out loans or selling bonds, like we said, in a primary market. Always a contract, okay? Always, almost always, structured so that if the company can't make its contractual payments, the lender has the right to take over the company. And the only defense a borrower has against that is you can run to a judge and ask for Chapter 11 bankruptcy protection. That really just postpones the inevitable. Your lenders are going to wind up owning the company. The judge is just going to make sure it happens fairly, and hopefully all the workers don't get fired and things like that. So we know the two types of debt, loans and bonds. We'll be dealing with them throughout the term. Okay. And then we went into derivative securities and shorting. So a derivative is always a contract, and its value is always linked to the performance of some other security, asset, or index called the underlying. And derivatives are used for three things. We saw how options are used for insurance, and we saw how futures were used for hedging. We looked at an oil company that was doing that, and these guys are both options and futures are used by speculators who are guesstimating what's going to happen in the future and using these things to make a lot of money if their wish comes true and not lose too much otherwise. And so we looked at option contracts. Definitely need to know about option contracts for exam one. Okay. There are calls and puts. A call option is going to give us the right, but not the obligation to buy a security like a share of stock or something like that at a certain price at a certain time in the future. And a put option is similar, but it gives us the right to sell a share of stock or something like that in the future at a certain time for a certain price. So you can buy or sell, a call or put, so you have four possibilities. We pretty much focused only on calls because I don't want to drive you guys crazy and let it get too complicated. So you definitely should be comfortable with the option contract examples that we did in class, we did in class quizzes, and you had for homework. Futures and forward contracts are used very much for hedging. If you are seeing something like the price of the oil you have to buy fluctuate around, going up and down, you might just say, I'm going to get a futures contract to buy it at $35 a barrel, even though I know it might be $25 a barrel when I need it. 3 months from now, it also might be $80 a barrel. So I'm just going to get a futures contract so I have certainty about the price I'm going to pay. I may win, I may lose, but I have certainty, and that makes it easier for me to plan for my business. And we talked about shorting. You definitely need to understand shorting of stocks in particular. Again, we did examples in class, in the homework. I think we had an in class on that one too. Basic idea is you borrow an asset, say a share of stock in our case, that you don't own, okay, and you sell it and you're hoping that the price is going to go down so you can buy it back in the marketplace, return it to its rightful owner, and enjoy a profit from that. Okay, so that's chapter 2. Chapter 3 is our review of accounting. And I hope you have seen by now that, as Warren Buffett says, accounting is the language of finance, particularly financial accounting. And we're going to use it all semester. So if you've just been thinking, oh, this is going to go away, I'll fake it through these couple homeworks, that is so wrong, and you really need to understand your financial accounting. If you don't now, just start working on it. It's probably too late for exam one, but start working on it immediately following exam one, or I can guarantee you're going to be very, very unhappy in this course, and frankly, it'll be hard for you to pass. Okay, so let's see here. We've got, we looked at a couple of examples. In finance, there were two particular things I wanted to illustrate for you. One is we use journal entries to see what's going on if something big happens without having to make a whole new set of financial statements. And to do that, we looked at our leverage buyout example. And that's where we have an entity wanting to reduce its number of owners. So it uses its money, the entity's money, to buy shares from some of the owners. It takes those shares, puts them in a burn barrel, and burns them effectively. So when the firm does this, this is called a share buyback. And we looked at a case where the firm, we're looking at West End Advisors, did this with a loan. It actually literally went to JP Morgan Chase and got a loan and used the proceeds to buy the shares back from one of the owners. Okay, and so we saw the journal entries for this. You take out the loan, you get the cash, but now you have a new liability, and then you buy back some of the owner's shares, and that's of course paid in capital. You live by the paid in capital, you die by the paid in capital, and paid in capital is part of equity, right? Okay. And then the cash goes out the door to pay that owner to get their shares. So the net effect here is that the equity goes down, and the debt goes up. Okay, so that's a debt for equity swap, this time financed as a leverage buyout. So we do that type of thing, use journal entries to suss out what's going on. The voluntary Chapter 5 on Fannie Mae gave another great example of how you can understand a lot of complicated stuff just by doing something like this without doing whole new financial statements. So here are the implications, and this clearly has made the firm more risky, right? Because now it has this additional debt liability where it's got to pay interest, and it's going to have to pay that back someday. When all this was in equity, what do you have to do with equity? Nothing, right? No promises. You just got to be not fraudulent. Okay, so it made the firm riskier. Okay, and then the other thing that we're going to be doing, we've already started doing, but we'll be using this with a lot of our models throughout the semester, is we're just going to use net PPE instead of PPE and accumulated depreciation. So it's a lot simpler. And it's very much like, for those of you who have seen it, the way that amortization of a patent works, for example. Okay, so the old GAAP method on a balance sheet, you'd see total PPE at cost here minus accumulated depreciation equals book value, and that book value is net PPE. Okay, and all we're going to do is just work directly with net PPE and not worry about these other two things. So it's definitely simpler. Okay, so what is net PPE? Net PPE is always just PPE minus accumulated depreciation. It's the PPE we've got minus the amount of wear that it has incurred, and it's a much simpler way to track things. So if we're tracking things in our company with net PPE, okay, when we buy it, we just say DR net PPE and cash flies out the door if we're paying for it in cash. And let's say it has 5-year life. So say 5-year life. Okay, and so at the end of 1 year, here you see this is, we're starting at XO, we go to X1, that's 1 year later. So we have to reduce the value of this by 20% because it's worn out by 20%. So our very simple way to do that is just depreciation expense. Whenever you have depreciation, it's always depreciation expense, and we just say CR net PPE. So very simple, very straightforward. So now on the balance sheet, all we show at the end of the year, we have one line instead of 3 lines. And you see the bottom line from the old accounting way is the same number, but you've got these two other things to deal with. We're just keeping it simple and having the one line. Okay, so those were the two specific things we went over, but as you know, you need to know financial accounting. As Warren Buffett says, financial accounting is the language of finance, and I hope you've seen so far that that's the truth, the whole truth, and nothing but the truth. Okay, so then handout 4 is we had 2 chapters on, well, really 3 chapters on finance applications of accounting. Handout 4 was the first one, and that's where we learned the balance sheet valuation method. Okay, and to get there, we had to understand that there are 3 measures of equity for an entity. And we've come back to this several times, so you really need to know this. So the GAAP measure just comes from the fundamental accounting equation, which says asset equals liabilities plus equity at all times under all circumstances. So through the magic of algebra, we can solve that for equity. So equity GAAP or equity accrual is equal to assets or at cost or cost minus square minus liabilities. Okay, second value of equity. So we have our 1 here. We have our 2 is what Warren Buffett would say Mr. Market is thinking that the value of this firm is to all its owners, all its shareholders. And that is always nothing more than the number of shares of stock outstanding times the price per share. Okay, and that's sort of a wisdom of crowds estimate. On average, everyone who's active in this company, owning a piece of this company, that's the weighted average view of everybody. Okay, and if we could buy all the shares of stock, we'd own 100% of the firm. Okay, and intrinsic value of the firm is simply our best estimate of what the firm is worth. Maybe we think Mr. Market is wrong, okay? And we're going to come up with our own estimate, and that's going to help us make an investing decision, okay? And in this chapter, we did this, I'll say, in this chapter, we do this using the market prices of assets and GAAP values for liabilities because that's the balance sheet valuation method. Okay, we're going to find other ways to get intrinsic value estimates of a firm's worth as we progress through the term. And then in general, this will always be true. We, as an erstwhile investor, we compare our estimate of intrinsic value or true value. We've also called this equity true. It's our sort of shorthand for intrinsic value. We compare that to Mr. Market's value, and if our estimate of intrinsic value is way much higher than Mr. Market's, we might want to buy some or all of this company and go from there. All right, so in particular, our method for getting an intrinsic value, comparing it to Mr. Market, in this chapter is the balance sheet valuation method. Okay, and the steps for that, we've done this in class with two examples. You've had this for homework, and we also, I think, had an in-class quiz on this. So first of all, find that intrinsic value and start with our GAAP balance sheet. Okay, so right, start with that. And the problem that we have with that is that it's showing its assets at cost or cost minus where, okay? And so we want to do two things. We want to replace the cost or cost minus where of the assets with market values, and those we have to go out and estimate, right? For HCP, their big assets are their buildings, right? They rent out space in their buildings to make money. So we would have to estimate the market value of each one of its hospitals, of its medical office buildings, all that stuff. Um, and then also we have to recognize that GAAP just completely ignores some assets. And for you, my marketing majors out there, you know what I'm talking about. I hope you have heard in your marketing courses about the extraordinary value of brands, and I hope your profs have complained to you how those are not recognized by GAAP accounting, and they probably should be. So, for example, the value of the Apple logo, clearly worth at least $1 billion or two, and it's nowhere on Apple's financial statements. And we did look at the example of Lenovo buying the ThinkPad business from IBM. So Lenovo does have that represented on their balance sheet, hidden in goodwill, because they paid a ton of money for the ThinkPad brand. They still use the ThinkPad brand, and it's their premier brand over at Lenovo. Big Lenovo fan myself. Okay, so once we've done that, we've morphed our assets from this sort of crummy uh, thing to estimate a company's worth into something much better, and that allows us to say our estimate of intrinsic value is equal to the assets at market value minus the liabilities, right? So equity true is our estimate of intrinsic value. Okay, so that's that. All right, what else we got going here? After we do that, we ask the eternal question, what does Mr. Market think of this thing? Well, Mr. Market always thinks that the value of the firm is the share price times the number of shares outstanding. So now we have our intrinsic value estimate, our best estimate, our equity true for the firm. We know what Mr. Market's view is, and we can now make an investment decision. Okay, so we can say, for example, if Mr. Market's view on what this entity is worth is way much less than we think, then maybe we want to go ahead and buy. Conversely, what if Mr. Market's view was way much higher than we thought the intrinsic value was? We could take a short position, right? We could short the stock and try to make money that way. We could also use puts, but again, I'm not holding you responsible for put options. All right, so enough of that. Let's move on to chapter 6a. This is a really long chapter, and I encouraged you all to start doing the homework for this chapter as we started, and I think only sadly about half of you did that. But anyway, that is what it is, and we are where we are now. So hopefully everybody's finishing up on this chapter in time to understand it really well for exam 1. So I'm skipping 5 here because 5 was completely extra credit. There was a homework for 5 that was about Fannie Mae. If you didn't look at that at all, it's going to have no impact on your ability to do exam 1 or exam 2 or the final exam. And if you did do it, good for you, awesome for you. I think that's a really interesting example, and I'm sorry we didn't have time to cover it fully in class. All right, so let's get into chapter 6. So we're still looking at finance applications of accounting, but now we're going to be focused on looking at what we can draw out of all the financial statements, not just the balance sheet. And we're always going to be looking at company's history and company versus comps. And I showed you recently a real world example of an analyst report. It was quite a good report that was published in Barron's. And he did exactly this, looked at the company's history, compared it to its comps. He had a lot of great ratios in there. If you have time, I would suggest reading through that. Okay, so we were looking at this methodology through the prism of comparing United Airlines to Southwest in the Great Recession, right around the peak, right? We know that the middle of March was the actual nadir, but things were pretty bad in Q4 2008. Okay, so again, bad time. So what does that mean for the airline industry? You always want to do this qualitative analysis, right? Clearly, travel is being curtailed and required travel. Nobody's going to let you travel first class anymore. If you're a business person, you're going to be flying economy. If you were first class or business class, not so much anymore. Okay. Also, we were in the Iraq War, and a lot of Iraqi oil fields were shut down at the time. So there was less supply, big demand, a lot of fear that there would be even less supply. So oil was spiking up at this time, the price of oil. We looked at um, Southwest market positioning and logistics. So logistically, it was one of these old hub and spoke airlines. We talked about that. And it had a very high cost structure because it owned a lot of different planes, meant a lot of different mechanical inventory to keep. The mechanics need to know how to fix all these planes. The pilots need to know how to fly them. The crews need to know how to handle them. All that stuff. And clearly, the bad economy and the Gulf War were causing problems. And from a marketing perspective, they were full service. They still are first class, business class, economy class. And we contrasted them with Southwest, which at the time it was established, but it was still an upstart, way much smaller than UAL, as we saw when we got to their sales. They were comparable, but it had about 2/3 the sales of UAL, and it was budget only. Its logistics model was that Spider on LSD model, where they would just opportunistically buy gates at airports as they became available for lease if they thought they could fit them into their existing drunken spiderweb and help them make more money. So that's called point-to-point logistics. And they only had 737s. That's come back to haunt them with the 737 MAX problem right now. But for most of their life, it just has definitely helped them cut down their cost structure a lot. Okay, and we talked about seasonal versus non-seasonal. In this class, definitely I would need to tell you if a company is seasonal. And if I don't say anything, you can assume it's not seasonal. But we talked about how can you tell if a company is seasonal. You can check the pattern of sales if we're in a good, healthy environment like we are now. The economy is expanding, all that stuff. So you can look for a sine wave of sales, and that would tell you throughout the year that it's seasonal. But one thing you can always do is go to an entity's 10K report filed with the SEC, and if they are seasonal, they gotta say so in the 10K. So just get out your little search function on your browser, search for season in the 10K, and see what it says. And if it's not there at all, if season is not there at all, it's not a seasonal company. So we found UAL is seasonal, Love should be seasonal too, and of course it is. And with all that in our back pocket, we jumped into ratio analysis, which is just taking numbers from companies' financial statements, making ratios out of them. And as always, when we do this, looking at a particular company, we want to look at the ratios compared to comparable companies and see how the company is doing compared to its history. Is it improving? Is it getting worse? That sort of thing. All right, so we had our three things that are important for most ratios. Remember, this was not always true for all ratios, but in general, so this one, let me say this one is always, we always want to have one sentence describing the meaning of the ratio and implying its usefulness, okay? Conceptually, that's extremely important. Every ratio that I've emphasized, you need to understand that, okay? And is bigger better or smaller better? I've said many times in class how to do that. Just hold the denominator constant. Ask yourself if the numerator increases, is that a good thing for the company or a bad thing? So that's how you answer that question. And is there a knife edge value separating good from bad? And it's typically 0, 1, or none. Okay, so a lot of the ratios had no knife edge. Some did. Okay, so like for example, the current ratio edge at 1. Why is the edge at 1? Because if it's less than 1, what does that mean? The company has more current liabilities than it has current assets, right? It has more definite obligations to pay cash within a year than it has cash and things it can convert to cash to pay for those liabilities. So less than 1 is bad. And someone brought up in office hours, which I thought was a great point, that like 1.01 is not good. In it's above 1, yeah, that's good, but in general you want to have a safety factor, right? So you want to have 1.5 times the current assets that you have current liabilities, or 2 times, or if you're a startup, 3 times. So you want a current ratio of 3. So the knife edge is just really telling us where we know below that, it's definitely bad. But, sometimes if you're just above that, it's not so great. But if you're below it, it's definitely not good. All right. And then we looked at our 5 approaches to ratio analysis: sales and sales growth, margins, etc. I'll march through all of them right now with us. And before we start on sales and sales growth, this has on this page, this is in this condensed Reader's Digest version of the notes, but it's also in the long form version of the notes I presented in class. Okay, this lists every ratio that I might ask you about. And I'll even go so far to say here, if I ask you very specifically about a ratio that's not on this page in a question, that will be by accident, and I'll just give everyone full credit for that question. So definitely you need to know the definitions of these ratios, and is bigger better, and if there's a knife edge or not. Okay, so then we went to sales and sales growth. So sales is the cardinal measure of the size of the firm. It's not the cardinal measure, of course, of the value to owners, which is number of shares outstanding times price per share. But the scale of the firm, the size of the firm, which is not the same thing as value to owners, is always measured by sales, right? And sales growth is a great measure of firm growth. It's actually the best measure of firm growth, and it's the only one I'm going to ask you about in this class. Also, many changes in a company's performance are just due to sales decline in the Great Recession, sales for many companies declined by like 40%. I mean, that's really shocking, but that happened. And that was really what drove a lot of bad things that happened to them. Similarly, company doing awesomely well, it might just simply be because their sales are growing so fast. Okay, great example of that for many years was Google. Google became more and more and more and more profitable just simply because their sales were growing fast and they had very, very little variable cost. Same thing with Microsoft, same thing with Facebook. Okay, so we're always going to want to look at sales and sales growth. And then we looked at an example here for sales and sales growth. So you can see that the sales of Love are about 2/3 the sales of UAL, but in the real world, that definitely makes them comparable. Um, and we see that we looked at how to compute these numbers. So sales of UAL grew by a little more than 10% in this year, Q4 to Q1, compared to the year before. And here, the sales in Q1 grew 9% compared to the sales in Q5, and et cetera, et cetera. Okay, so sales growth is always sales new minus sales old over sales old. Okay, and then on this page, I'm not going to go over it again here because I've gone over it so much, but this page describes to you exactly how to read these tables, and really important, every single number that we computed in class you should be able to recreate. And I've explained in class and in great gory detail in exam 1 information recommended studying methodology for exam 1, and thing number 1 is make sure that every example we do in class you can reproduce from scratch. And you should do that first because that's going to make it light years easier to do the homeworks and the in-class quizzes and things like that. All right, so I will leave you to this reminder right now. Look at exam 1 information. It gives you all my recommendations on how to study, and look at this page because it reminds you exactly how to read these tables. And here's some more great examples of computations of numbers. If you do these computations before you try homework 6A, it will just help you avoid so much grief. Okay, so then we went on to margin ratios. Okay, and margin ratios are typically some expense or earnings measure over sales, but in their most general sense, they could be any income statement or cash flow statement quantity over another income statement or cash flow statement quantity. Okay, and we started, we looked at profit margin, and we looked at Vermont organic apples, and so this is the profit margin, right? So profit margin, the most important margin ratio for sure. And that doesn't mean the one I'm most likely to ask you about, but definitely most important. And Vermont Organic Apples was doing pretty good with a profit margin of 5/20, which is 25% in most circles, right? And the erstwhile investment banker did a sum of the parts analysis, noting that they sold apples and they also made apple butter and sold that, and that the profit margin for the apple butter business would be way much worse than the apple business. So if they jettison that apple butter business, that's what the investment banker recommends. They've still got to pay their accountant and all that jazz. So they are going to have this other expense for accounting and stuff like that. But if they jettison the apple butter, they'll have a pile of money from selling it, and their profit margins will increase wildly. And of course, the investment banker makes a big fee. Okay, and then we looked at turnover and efficiency ratios, and these are the ones that caused everybody trouble because when we had quarterly ratios, we always annualize these. So, whoops, let me get that. Sorry, we're moving around here. I'm not trying to do that. Annualize quarterly versions of these. So my economics majors out there, you're very familiar, hopefully, with doing this kind of thing. And hey, I spelled that right. Okay. You're very familiar with doing this kind of thing. You have annualized economic numbers all the time. And for the rest of us, I'll go over once again how to get these. But turnover ratios are these ones that are mixing a balance sheet term with an income statement or a cash flow statement term, okay? And that's why we're going to have to annualize when we have a quarterly number, okay? So we have chosen, see, here's the problem. And for my one engineer across two sections, you know what I'm talking about here. But the units of all the numbers on balance sheets are dollars or millions of dollars or something like that. And the units of all our numbers on income statements and cash flow statements are dollars per quarter or dollars per year, something like that, okay? And because we're mixing in these ratios, dollars with dollars and time, the time units aren't going to cancel out. So we have to choose what time unit we want. We choose years, okay? So we want consistent time units for these ratios. So we choose years, okay? So what does that mean? Whenever we're doing one of these ratios and it's a quarterly basis, just multiply by 4, okay? So multiply by 4. All right, multiply what? The IS or CFS number by 4 and then compute the ratio, okay? So okay, so if it's an efficiency or turnover ratio and it's quarterly, here's all you got to do. This is always, always, always going to work, right? Multiply the income statement or cash flow statement number by 4, then compute the ratio. Always going to work. Don't do that if it's an annual number because the units are already here in years if it's an annual number. Okay, and here's exactly the same rule that I have on the previous page. So you've seen it twice here. This is also in the long form notes that I presented in class. Okay, so for turnover efficiency ratios, if you've got quarterly, take that quarterly income statement or cash flow statement number, multiply it by 4, then compute the ratio. Always gives you the annualized right answer. All right, good. So we also talked about a few times in this chapter, we asked questions for important ratios. How could we improve it? And we wanted to go back to grammar school and just look at the ratio and say, how could I make this ratio bigger? I could increase the numerator or I could decrease the denominator. So for ROE, what does that mean? If we increase the numerator, we're increasing net income. That would clearly be an operational strategy. We're trying to improve our operations. We're trying to increase our sales and reduce our operating costs, okay? If we decrease our numerator, what are we doing? Our denominator, what are we doing here? We're decreasing our equity. We're doing a debt for equity swap, right? And that could be like a leverage buyout or something like that. And that would be a financing or a financial engineering type of strategy. And again, remember in finance, if you can make it so algebraically, it's either been done, it's being done, or there's a financial engineer working at this moment who's going to try and make it so in the future. All right. And then we got into leverage, extremely important, right? We are going to keep coming back to leverage throughout the semester. So we spent some quality time on this, extremely, extremely important. So we had two types of leverage, financial leverage, which is all about debt financing. I think the best way to measure it is debt financing versus total financing, or debt over some measure of income or cash flows. Operating leverage, very different cause. Okay, operating leverage comes from having more fixed costs than variable costs. Okay, and we talked about what fixed costs are and what variable costs are. So the causes of operating leverage very different than financial leverage, but the result is the same in both cases. More leverage, better results for owners in good times, better ROE for owners in good times, more risk of bankruptcy in bad times. Okay. And so that's what I've got written down for us here. So their leverage ratios, now we're a little bit too complex for just bigger is better. Our leverage ratios are measuring upside to owners in good times and risk of bankruptcy in bad times. Okay, and financial leverage we looked at first. That's the most common because it's easy to get from the GAAP financial statements. And we looked at two examples for this. We looked at the conservatives versus the cowboys, and each group had 100 million dropped on their heads to invest, and they each went about buying this company, Prefab Home Builders, and the conservatives, the equity here was the firm was for sale for 100 million, equity 100 million, no debt. So they just bought the whole firm, and the income statement looked like this with net income of 15 million, and that was in a good year, and things proceeded that way for a while after they bought it. The Cowboys bought this firm in a different way, okay? For the 100 million that they got dropped on their head, okay, they only spent 10 million of that to purchase this firm. But remember, the firm is for sale for 100 million. So where'd they get the other 90 million? Well, they went to JP Morgan Chase or Bank of China, and they said, hey, this is an awesome company. I want you to make the company, not us cowboys, but make the company alone at the moment of the sale of the company, and that 90 million proceeds are going to be used with our 10 million to make the 100 million that we need to buy the company. And that's really great, except now, of course, the company has 90 million in debt obligations that it didn't have before, and the interest rate on that is 10%. So if we go through the income statements now, for the conservatives, the company's running just as it was, didn't have any debt, doesn't have any debt. And for the Cowboys, because of this 9 million, right, we've got less net income, and we don't have exactly 9 million less net income because of the tax shield, right? Okay, so, so if it was exactly 9, they would only be getting 6 million in net income. So the tax shield has really helped them there. And the incredible thing here is that the conservatives have a pretty good ROE, but the Cowboys have this almost scandalous 82.5% ROE. That's really high. That's really high. And you say, yeah, but they only got 8.25 million in net income. Yes, but they still have 90 million, so they can buy 9 more companies like this and get 8.25 net income from each one. So what are they getting total? 82.5 million in net income. That's pretty awesome. And they are diversified. And then we saw what happened in a bad year, however, because they got to pay this interest. It's a contract. They might be in big trouble with their earnings before tax and their net income. And if they don't have enough cash on hand to make this interest payment to JP Morgan Chase or Bank of China, they've got to either declare bankruptcy or turn over the keys of the company to the lender. Okay, so you get awesomely great results with leverage, financial and operational in good times, but it really increases your risk of bankruptcy in bad times. Okay, so all of these key takeaways are summarized for you here. I'm going to let you read those on your own. Okay, we've got the 2 pages of takeaways there. You should review them. I'll let you review those on your own. We have actually 3 pages of takeaways here, so check those out. Then the other example that we looked at, and you can count on one of these examples, either a private equity type or a capital budgeting type. We looked at thinking about buying either 1 unit here or 2 units here and doing a gut rehab and then selling. We happen to have enough of our own cash, that would be our equity investment, to buy 1 unit. So if we want to do this for 2, we're going to have to take out a loan to get us enough money to buy both units. And we compared those. We also had an in-class example on this. So there's the buy 1 unit option. That's no debt because why? We have a capital budget of 100. The building is for sale, half the building for 70, plus our gut rehab costs are 30, so that's where our 100 comes from. Or what we could do is buy 2 units, in which case we'd have to take out a loan for 100, and our total capital budget would be 200, and we'd have 50% equity capital budget and 50% debt capital budget. And then we just work our way through. So if we buy 1 unit, it's 70,000, 2 units, 140. The gut rehab costs for 1 unit are 30, 60 for 2. If we just buy 1 unit, we're doing this with our own $100,000. We have no debt, but we're going to have to pay 10% interest on this $100,000 loan otherwise, so that's $10,000 for our levered $100 loan option. We think we can sell each unit after we've done the gut rehab for 125. That's pretty cool, from 70 to 125. If we have 2 units, we'll be able to sell each one for 125, get 250, work that through, and you see that we get much higher net income in this case, if we do 2 units, and much higher ROE. It's not twice as much, of course, because we have to pay the interest. And of course, it's way riskier to do this, right? Because if things go wrong, really badly wrong, we lose our 100,000, but also now we have a contract that we have to pay back. So you can always lose more money in a situation like this than you put in. Okay, so of course it's riskier to go with leverage. All right. Okay, and then operating leverage, as we say, measures fixed costs to variable costs. And for us, we're going to say fixed costs are costs we can't eliminate in a quarter. Okay, in general, they're costs that don't scale with small or medium increases in sales. Variable costs are just the opposite. These are costs that scale linearly with small or medium increases in sales, and we're going to say they're costs that could be eliminated in a quarter, just to keep things simple for us. That's a little artificial, but I want to keep it simple. Okay, and so operating leverage, like I said, very similar in effect to financial leverage, higher operating leverage, better returns to owners in good times, but more bankruptcy risk, okay? And they're not completely independent because interest is clearly a fixed cost, but it's also related to financial leverage. And then we went through West End and the Carpenter. Neither of them had any debt, so we were able to remove the financial leverage from the picture for this one. And we saw how in a good year, even though the Carpenter has a bunch of variable costs and West End does not, that their net income was identical. But in a bad year, the Carpenter's variable costs get reduced, and West End has nothing but fixed costs, so our costs are not reduced at all. Okay, and you'll see she does much better than us in a bad year. She has double basically the ROE than we have. And in a very good year, however, we've got this beautiful thing that even though our revenue goes way up, our cost structure has not increased. And this is how Bill Gates became the second wealthiest person in the world. Microsoft, when he was running it, had a very high fixed cost structure, almost zero variable cost structure. So in very good years, the revenue of Microsoft would just crank up, almost no variable costs, so that would drop right down to the tax line and to profit. So with the Carpenter, as she does more work, she needs to buy more nails, buy more gas for a truck, buy more sheetrock, all that stuff. Her variable costs go up, and so she cannot keep up with us in the ROE department. And this never is going to be true forever for any firm. If the Carpenter gets 200 hours worth of work a week, what's she got to do? She's got to hire someone to work for her, and that's going to be a fixed cost, paying that employee and the truck for that employee and things like that. Okay. And here are key operating leverage takeaways. I'll leave you to read those on your own. They're pretty much what we just talked about. Definitely read these over. Okay, and then finally, our last ratio analysis method was liquidity. Okay, and we had our general important definition of liquidity. It's a measure of a firm's ability to quickly produce cash to meet potential or certain short-term obligations. And we also looked at a more specialized real-world example. One of the 20 biggest in the banks in the world collapsed in the Great Recession because it was not liquid. It thought it was liquid, but it wasn't because nobody would buy the junk they had for sale that they thought they could sell. Um, okay, so our liquidity ratios are always measuring sources of cash versus cash obligation, something like that. Bigger is better to a point. Always to a point, because if you have too much cash, your shareholders get pissed off. They're not investing in you to create the mother of all piles of cash, and they'll start saying, hey, you need to dividend some of that pile of cash back to the owners. And usually they win that fight when they start fighting that way. Um, so what are our sources of cash? Current assets, we know what those are from accounting, or working capital assets. Cash flow from operations, right? That's generating cash for us, hopefully. We talked about revolving lines of credit. Those are like a credit card for a company. And the obligations, current liabilities or working capital liabilities. If your operations are burning cash, you have to put cash into them. That's a cash obligation. Remember, GM's operation had to put $5 billion into their operations to make all their cars and trucks per quarter in 2008. That's not good. Interest is clearly an obligation. Depreciation is not, but CapEx definitely is. CapEx is maintaining and increasing as necessary our property, plant, and equipment. So for Love and Southwest, that would be maintaining primarily their plans, replacing the tires, replacing the engines for the flaps, replacing anything that breaks. That's all CapEx. So we talked about what CapEx is, need to know what that is, need to know where to find it, and it's on the cash flows from investing portion of the cash flow statement. And we talked about working capital. I'm not going to ask you to compute a working capital ratio. We talked about why not in class. It's really something you can't do algorithmically. You usually have to go to the notes to the financial statements, but you definitely want to know what working capital accounts are. So here's a definition. What do you do when you see a definition? You memorize it. So you need to know, you need to have memorized that definition and see how that all plays out down here. And we've got, once we know what working capital accounts are, we also need you to know the definition of working capital. This comes up in finance every day, basically. So you need to know that definition. And I've got it described for us here. And this one, even though it's not a definition, a ratio, we can talk about it sort of like it is. Bigger is better up to a point, and negative is never good. Okay. And we talked about EBITDA. EBITDA is just like EBIT, except now we're also excluding depreciation and amortization, if any. How do you know if there's amortization? Well, if it's on the income statement, you got it. And if it's not, then you only have depreciation. And if there's no depreciation, it just means you don't have any PPE, so it's not wearing out. Okay. So yeah, if your EBITDA, if your earnings before we pay interest or taxes or register our depreciation or amortization, if that's not greater than zero, you really just give up. Okay. And then we talked a little bit about our alternate framework, the DuPont identity. You do need to know this too, okay? And instead, the DuPont identity, instead of looking at our 5 various ways to think about ratio analysis, it thinks about 3. So this is the key equation for the DuPont identity. It just takes the definition of ROE and in a cute academic-y kind of way expands it into net income over sales times sales over assets times assets over equity. So you see the red cancels with the red, the purple cancels with the purple, and you're wound up back again with net income over equity, or ROE. So what does this mean? It means it's thinking about three components. Clearly, that first one, net income over sales, is thinking about margin, specifically profit margins. It's thinking about efficiency ratios. This was the first efficiency ratio we looked at, sales over assets, our asset efficiency, and it's looking at leverage. It's looking at it in a way that we didn't look at it. I don't know anyone in the real world that looks at leverage this way, but I guess some academics do. So they're measuring leverage by assets over equity, where we've been measuring it by debt over debt plus equity, or debt over assets, something like that. If you measure it this way, it's called equity multiplier. Okay. So what's it ignoring? Well, it's ignoring a lot of the ratios we developed, and it's ignoring sales and sales growth and liquidity entirely. Okay, so that's the story there. All right, and that's it for 6A. Let's move on to 6B. And in 6B, we wanted to do two things. We wanted to improve what we had done in 6A in two ways. We wanted to introduce a sort of formal risk-reward framework for the first time. We implicitly used this framework in the first class with HCP, but we formalize it here, and that helps everybody. And then the second thing we did in this chapter was we started adding market data to our financial statement information, and that, as we saw, is especially helpful to equity investors. So what else did we do in this chapter? We went over the development of our risk-reward framework, and we broke it into two parts: debt investors and equity investors. So in both cases, we've got, you want to think about your reward analysis and your risk analysis. Okay, so for debt investors, it's basically what's the interest rate we're going to receive, assuming the company doesn't flame out. That's it. Pretty simple. And for risk, and this is going to be true for any financial analysis conceptually, what could go wrong? What's the probability that something goes wrong? And how big a loss do we incur if something goes wrong? So in debt in particular, what could go wrong is also pretty simple. It's basically, could the company default on the loan or bond contract? That's about it. That's about all that can go wrong. But these three questions are going to be for any type of financial project. Okay, then we went to equity investors. Okay, and we reward for them depends on what type of, what you're looking for as an equity investor. If you're looking to buy the stock at a low price, sell at a high price, then that's your reward. How much is it going to go up after we buy it? And if you're a more conservative stock investor, you're buying the stock maybe to get dividends, and you're hoping that the stock price doesn't go up or down, well, at least down too much. So you're saying, how big will our dividends be? And for risk, again, exactly the same conceptually as for debt investors. What could go wrong? What's the probability something goes wrong? And how big a loss are we going to incur if something does go wrong? But specifically for stock investors, what could go wrong is the stock price could fail to go up, or it could go down instead. That would be bad. And what if the dividends are reduced or stopped altogether? That happened to firms that had been issuing dividends and always increasing their dividends for as much as 80 years, stopped issuing their dividends in the Great Recession. And that was bad for a lot of people that were counting on that. But for the companies involved, was there Any problem with that? No, because dividends are not contractual obligations. They can stop paying their dividends whenever they want to, and a lot of them had to in the Great Recession. All right, so then we said if we're gonna do this stuff to add our market data, this is going to help equity investors. So we wanted to know who are our beautiful equity investors, and we looked at three major types of investors. Value investors like Warren Buffett and Merrill Whitmer, and they're doing their analysis with a risk-reward framework, balance sheet valuation, or DCF methods, discounted cash flow methods, which we're going to learn later on. Second up, we're relative value investors, and they're asking things like, is the company going to outperform its peers? And they want to find the best company in an industry or a group, and maybe the worst also. And they're going to buy the best and maybe short the worst. And I gave the example of the folks running the Harvard Endowment, and they would try to buy the best 2 or 3 companies in an industry, short the worst, and they made money in almost all conditions as a result because they were good at making those estimates of who's going to be best, who's going to be worst in this industry. And then, as I talked about, because of the spread between best and worst, they made money in almost all circumstances. So they're always also, they're going to start doing all this through a risk reward framework, and they're going to use ratio analysis with market data, which was the subject of the rest of the chapter, or DCF methods, which we're going to learn later. And finally, other big bucket of investors are growth investors, and they're just asking, is the company going to grow sales and net income more quickly than sales? Beautiful example of that over the past year is Tesla. Tesla had no net income a year ago. Its sales were growing. Its sales started growing a lot faster when they moved into China. They came out with the Model 3 and they became net income positive, and their stock price has just gone parabolic. It's just exploded. So that's a classic growth investing story. In my opinion, not enough risk reward framework for people investing in Tesla right now, but the professionals are doing that. And what are they doing? Ratio analysis with market data, which we're learning about in this chapter, and DCF methods, which we learn in future chapters. Okay, so we're really going to be focused on, in this chapter, relative value investors and growth investors and helping them. So then to start doing investment ratios with market data, we wanted to remind ourselves of the 3 measures of equity: gap, market value, and intrinsic value. And why did we do that? Because really what we want to do in this chapter is just replace mostly we just replaced equity gap with Mr. Market's view of the equity. Okay, and that was actually quite a good thing. Mr. Market may be right or may be wrong, but Mr. Market is probably an awful lot closer to the estimate of what a company is worth to its owners than gap equity, which is just this weird assets at cost minus liabilities. It's just not very helpful. So we went through and we got some market data for UAL. To do this, we need the market data. All we need, we don't need much, is shares outstanding and price per share. And from that, we can get the equity just by multiplying those two together, equity market value. And then we could go through and do our ratios. So we did ROE market value, just like ROE in the previous chapter, except now we're using equity market value. We learned a couple of new ratios. We learned the PE, which is very similar to ROE. It kind of looks like 1 over ROE, and the difference is the timing. For ROE, we always want equity beginning of period, and for PE, we always want equity end of period. Otherwise, they pretty much are 1 over each other, okay? Um, and PEG ratio we didn't bother with. Again, I have these things all here for us because we do use them actually in the office, but you don't need to know PEG. It's a gray page. Don't worry about it. We did talk about dividend yield and payout ratio and debt to enterprise value. That was our analog for debt to capitalization, except now instead of using equity gap, we're using equity market value. When we do that, we're using down here the enterprise value instead of capitalization. Okay, and that was helpful. We talked about why that was helpful. If I'm a kind of shady character and I buy a firm that is capitalized with debt and equity, the lenders from the debt part of the capitalization, they have the right to say, we don't like you as a new owner, so we're making all the debt due and payable the moment you buy the company. So really, I can't buy the company just for the price of the market value of the equity. I've also got to pay off all the debt or find another lender who will refinance that debt for me. So enterprise value is important for that reason, among others. Okay. And then I showed you here for all these numbers, we didn't do it in class, but I showed you exactly how to compute all of these numbers, okay? And I only did TTM, so hint, 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 I'm not going to go crazy with these ratios on the exam. I think I've said in class we've got about 5, maybe a couple more than that, ratios to compute from 6A, and maybe 3 from this chapter. And equally important or more important are going to be the questions about what these ratios mean. Okay, yeah, so we did look at some questions, and then down here I've got, just to help us out, I've got all of the financial statements, so you can just stay in this condensed version of this handout when you're computing these numbers and just refer to, you can refer up here to get the market data, and you can refer to down here to get the information you need from a balance sheet or income statement or cash flow statement. And that's about it. That's about it. In one sense, it seems like a lot that we have covered. In another sense, conceptually, hopefully it all sort of hangs together and is fairly straightforward. So I think if you understand all of the concepts we've gone over here, and like I say, if you can do from scratch every numerical example we did in class, every numerical example in the homework, every numerical example in the in-class quizzes, you should be able to do like really well. I hope always springs eternal. I'm often disappointed with this, not just at Miami, but everywhere. But hopefully, if you have done all those things, you're going to do really well on exam 1. And I wish you the best of luck on exam 1. And that's it for me. Over and out.